Capitalism without failure is like Christianity without hell. Frank Borman. Failure is the filtering mechanism of every permissionless system. The only serious question is whether your architecture survives operating inside that filter. 99%, 53.2%, 20 million tokens, 97%. Those four numbers frame the entire crypto industry, and almost nobody hands them to a newcomer in one place. That is why this video exists. 99% is the estimated token failure rate across the entire market. 53.2% is the percentage of tokens tracked by CoinGecko that have already failed since 2021. 20 million is the number of distinct tokens ever launched, according to Gecko Terminal. 97% is the failure rate of meme coins, the category most newcomers enter through. Hold those numbers in your head, because the rest of what you are about to see depends on them. If you have heard people argue that crypto is a scam, these are the numbers they point at. If you have heard people argue that crypto is the most important wealth creation event of the modern era, they are looking at the same numbers and reading them differently. Both interpretations are wrong about what determines the outcome. What this video does is give you a structural reading. What the numbers actually mean, what history says about industries that produce them, and what the academic data says about who survives inside them, and what the operator-level architecture looks like for the small group of participants who consistently turn that 99% failure into a source of genuine wealth. If you are entering this industry for the first time, this is the orientation document. Read, watch, and learn before you put a single dollar at risk. Let me walk you through this. Okay, here's what's coming. First, the scale of the problem. How many tokens have actually been created and how many are gone? The numbers are larger than most people can imagine. Then, the headline mortality study. The one that put real data behind the failure rate everyone in this industry talks about. Then, category by category. Meme coins, NFTs, GameFi, DeFi, AI tokens, layer 1s, layer 2s. The failure rate is not uniform across them. The variation tells you something structural. After the ICO era, the forensic case study, what the 2017 to 2018 boom taught us about crypto mortality and why most operators alive today learned the trade from that wave. Then I will take you out of crypto entirely into the .com era, because everything we have just covered has happened before in another industry and produced one of the largest wealth creation events of the modern era. Then the academic data on skill, the single most important set of findings in this report. Then the market that separates survivors from the dead, visible to anyone willing to look. Then the framework I use to navigate all of it. 4 roles, 4 games, 4 different relationships to the same 99% failure rate. And then the conclusion. How many tokens have actually been created? That is the right place to start, because most newcomers cannot hold the answer. It depends on what you count. Roughly 120 million tokens have been deployed across all blockchains, including those that never traded a single block. Around 50 million have traded at least once on-chain, and according to June Analytics, 20.2 million were tracked specifically on CoinGecko Terminal from 2021 and 2025. That is the dataset behind mortality study we are about to look at. And only about 18,000 appear on CoinGecko's curated active listing today. Hold those numbers next to each other for a moment. The 18,000 are the ones with enough liquidity, volume, or community attention to warrant tracking. Behind that visible layer sits 20 million more that have already been filtered out, and another 100 million that never made it through the door at all. The launch trajectory tells you why. In 2013, there were roughly 66 active cryptocurrency projects. That's when I started. I started end of 2015, and they were still not that many. I believe 160. By 2017, during the first ICO wave, that number had risen to 10,000. By 2021, with the DeFi and NFT explosion, over 100,000 more. By 2023, with the rise of mass launch infrastructure, 2.5 million. By 2025, with Pump.Fun and similar Solana-based factories, more than 20 million. Ridiculous. Pump.Fun alone has launched 12.7 million tokens since its inception. It produces between 22 and 30,000 tokens every single day. Now, look at where the value actually sits. Despite 20 million tokens have existed, the top 100 account for over 85% of total cryptocurrency market capitalization. Bitcoin and Ethereum alone represent approximately 75% of the entire cryptocurrency market. This is a power law distribution, not a random one. The same shape that governs venture capital outcomes, music industry revenue, film industry profits, and book publishing. A small number of winners capture almost all value. The long tail is extraordinarily long and almost entirely dead. Now, the headline finding. CoinGecko January 2026 study is the most rigorous token mortality analysis available. They tracked approximately 20.2 million projects on Gecko terminal between July 2021 and December 2025. They found 10.7 million had failed already. Failed defined precisely. Ceased to exist and ceased trading entirely. Delisted from all venues, or 99% or greater value loss with zero recovered liquidity. 53.2% of all tokens launched in the last 5 years are gone. The breakdown by year is the part that should stop you. 2021 accounted for 3.2% of those eventual deaths. 2022, 5.8%. 2023, 6.5%. 2024, 8.1%. Then came 2025. 86.3% of all token deaths across the entire 5-year tracking period happened in a single 12-month window. This is the part beginners do not understand about volatility. They think volatility means price move up and down. That is true, but it is not structural truth. The structural truth is this: volatility events permanently eliminate the structurally weak. They do not just reduce prices. They remove projects from the arena entirely. The capital, the team, the community, the liquidity, the market makers, the listings, all of it gone, in some cases inside a single trading session. A single event drove most of the 2025 destruction. October 10th, 2025. Most of my crypto peeps that have been that day in the market, you know what I'm talking about. A liquidation cascade that wiped out $19 billion in leveraged positions inside 24 hours window and triggered 7.7 million token failures in Q4 alone. A volatility event of that scale is not a market correction. It is a selection pressure. It does not affect every project equally. Projects with real users keep their users. Projects with real revenue keep their revenue. Projects with developer activity keep their developers. Projects with none of those things, projects that existed only because of upward momentum, are the ones that disappear. The 53% headline becomes much more uncomfortable when you break it down by category. Start with meme coins, the 97% category. Pump.fun, the dominant meme coin launchpad on Solana, has created 12.7 million tokens since launch. Of those, only 0.7 to 0.8 ever reached a $90,000 market cap. The average token survives 12 days. 75% die within 24 hours of launch. By day 7, 93% are dead. The wallet level numbers are sharper. Of all wallets that have ever interacted with Pump.fun, only 0.7% have profited over $10,000. Only 0.03%, roughly 8,100 wallets globally, have earned over $1 million. If you walk into this part of the arena and start clicking on tokens randomly, those are your odds. They are not slightly worse than retail in traditional finance. They are catastrophically worse. Now, NFTs, the 96% category. Dab Gamble analyzed 73,257 NFT collections and found 95% had a market cap of 0 Ethereum. 0. The 2024 follow-up study confirmed 96% of NFT projects dead, with an average project lifespan of 1.14 years. For 2024 NFT drops specifically, 98% were effectively worthless within 12 months. Only 0.2% of 2024 NFT investments proved profitable. The NFT category is the purest distillation of the broader dynamic. Speculative demand creates a short-term price discovery. The absence of structural utility produces near total attrition. When attention contracts, there's nothing underneath to catch the fall. GameFi and play to earn, the 93% category. CoinGecko analyzed 2,817 Web3 games in November 2023 and found 75.5% had become inactive with an annual failure rate of 80.8%. The subsequent Chainplay and Storable study of 3,279 GameFi projects placed the failure rate at 93%, with an average project lifespan of just 4 months. Average token price declined from all-time highs, 95%. 58% of GameFi venture investors suffered losses, with returns ranging from negative 2.5% to negative 99%. These are professional allocators with deal flow, term sheets, due diligence teams. The category broke them too. The combination of speculative tokenomics and unsustainable play-to-earn mechanics created a structural dependency on new capital inflows. The defining characteristic of any system without a genuine utility foundation. Now, DeFi, the 61% post-hack failure rate. DeFi deserves a separate note here because its failure mechanism is structurally distinct. DeFi projects do not usually die from lack of attention. They die from architectural vulnerabilities. Smart contract exploits, oracle manipulation, governance attacks, unsecured bridge infrastructure. Direct database documents $77.1 billion in total DeFi losses from scams, hacks, and exploits since the category emerged. Only $6.5 billion has ever been recovered, a recovery rate of roughly 8%. Of 64 DeFi protocols that experienced hacks of $1 million or more, only 39% survived. The rest functionally died after the exploit, with total value logged dropping 96% or more and never recovering. This is a different kind of failure from a meme coin going to zero. This is technical governance failure. It tells you that even projects with real engineering teams, real liquidity, and real usage can be eliminated overnight by a single architectural flaw. The failure rate reaches into every layer of this industry. AI-related tokens, the 75% value loss category. AI-related crypto tokens peaked at approximately $55.5 billion in collective market capitalization before losing approximately 75% of their value in 2025. Roughly $53 billion in market cap raised in 12 months. Less than 1% of those projects show real adoption metrics today. The mechanism is one of the industry repeats with each cycle. A genuine technology theme attracts massive speculative capital before underlying technology has produced real adoption. The vast majority of launches produce near total value destruction. A small number of projects with genuine compute infrastructure and actual usage retain or grow their position. The same shape every time. Now, the infrastructure layer, layer 1 blockchains and layer 2 scaling solutions. The lowest failure rate in the industry, but not zero. Infrastructure projects exhibit the lowest failure rate because they require substantial investment to launch. Engineering, cryptographic research, node network coordination, developer recruitment. That investment creates a natural barrier to entry that filters out low-effort projects. But lowest failure rate in crypto is relative. Of the top 20 cryptocurrencies from 2017, the majority have fallen out of competitive relevance. The former Ethereum killers, iOS, Neo, Cardano, as a smart contract platform, IOTA, not zero in most cases, but functionally inactive at the developer level. The Electric Capital 2024 developer report showed that while total developer numbers declined 7% in 2024, established developers with 2 or more years of tenure grew 27% year over year. The infrastructure layer is consolidating around fewer, more serious teams. Infrastructure projects have lower failure rates not because they are immune to death, but because building real infrastructure creates real barriers to abandonment. The same logic that protects them from quick failure also makes them harder to launch in the first place. Hold the full picture together for a moment. Meme coins, 97%. NFT projects, 96%. GameFi, 93%. ICO era projects from 2017 and 2018, 80%. AI tokens by value loss, 75%. DeFi post-hack mortality, 61%. The top 20 layer ones from 2017, 60%. All tracked tokens since 2021, 53%. Every category in the crypto ecosystem fails at rates that would be considered catastrophic in traditional industries. The variation between categories reflects structural differences in barrier to entry, utility dependence, and capital requirements. Not differences in fundamental viability. The numbers come from CoinGecko's January 2026 study, Dub Gamble, Chainplay, and Storable. Statis Group, Ernst & Young, Direct Database, Yahoo Finance, Messari, and Electric Capital. 8 independent sources. The numbers are corroborated. And here's the structural insight that runs underneath all of them. Failure rate correlates inversely with barrier to entry. A meme coin requires no capital, no team, no technology behind a copy-paste contract in a Telegram group. A layer 1 blockchain requires years of engineering, cryptographic research, node network coordination, and developer recruitment. The failure rate of the first is 97%. The failure rate of the second, even taking the most generous reading, is significantly lower. This is not a moral observation. It is a structural one. Permissionless systems do not punish the people who launch low-quality products. They simply allow the market to filter them out at scale. The lower the cost of launching, the more launches there are, and the higher the proportion that fail. Where you operate inside this stack matters as much as what you operate. Before, the historical parallel that most people miss one more piece of crypto internal context. Because the broader industry pattern was not invented in 2025. It was first documented exhaustively between 2017 and 2018. The ICO era, the first mass experiment in crypto failure analysis. More than $50 billion was raised through initial coin offerings during that 18-month window. It is the period where we have the most rigorous academic data. 3 studies are worth knowing. Satis Group, July 2018, analyzed over 1,500 ICOs and concluded that 78% of them were scams by project count. Only 15% ever proceeded to an exchange listing. The Boston College study by Benedetti and Kostovetsky, published as a Journal of Finance working paper, examined 2,390 completed ICOs and found that 56% had failed within 4 months of their token sale. Of projects that did not achieve an exchange listing, 83% were inactive within 120 days. Ernst & Young's class of 2017 study examined the 141 largest ICOs by capital raised and found 86% trading below their listing price by late 2018. 71% had no working product or even a prototype. The internal phrase EY used in their summary was that the situation was worse than they expected. The Boston College finding is the one to hold on to, because it carries the structural lesson. Of ICO projects that achieved exchange listing, 16% went inactive within 120 days. Of unlisted projects, 83%. The act of listing itself was a powerful natural filter. Listing required market maker relationships, legal compliance, real liquidity, audit trails. The filter did not catch everything, but it caught most of it. The structurally weak failed before they got to the gate. The pattern is now visible across every cycle. Every wave of token issuance produces an enormous failure rate within the first year. The structurally weak die fast. The structurally durable persist. By the time the next cycle begins, only the projects with real building activity, real users, or real liquidity have made it through. The 2017-2019 wave is what every serious crypto operator alive today learned from. We watched 86% of the most heavily funded projects in the industry trade below their issuance price within 18 months. We watched 71% never ship a product. The lesson was not that crypto was over. The lesson was that early cycle issuance is structurally where capital goes to die, and that the survivors had identifiable characteristics from the beginning. Now, I want to take you out of crypto entirely because everything we have just covered has happened before in another industry and produced one of the largest wealth creation events of the modern era. Between 1995 and 2001, approximately 7,000 to 10,000 new internet companies were launched in the United States. By mid-2003, roughly 4,800 had been sold or gone under. At least 1,100 internet companies filed for bankruptcy. The Nasdaq fell 78% from peak to trough and did not reach a new all-time high until April 23rd, 2015. 15 years later. The numbers map almost exactly onto crypto. Internet companies launched 7 to 10,000. Crypto tokens launched over 20 million. Failure rate of tracked entities, roughly 50%. In .com, 53% and rising in crypto. Nasdaq peak to true decline, 78%. Bitcoin peak to true in 2022 cycle, 77%. Market cap destroyed, $5 trillion in .com, over $2 trillion in crypto, 2022 alone. Amazon dropped 94% from its peak during the dot-com crash. Bitcoin dropped 83% from its 2021 peak in 2022. These are not different patterns. They are the same pattern with different technology underneath. The failures were spectacular on both sides. Pets.com burned through $110 million and lasted 268 days from IPO to liquidation. They spent $19 in marketing for every dollar of revenue. Webvan consumed $800 million before collapsing. eToys went from an $84 share price to 9 cents inside 16 months of its IPO. Over 80% of dot-com IPOs were loss-making in the year preceding their float. These companies failed catastrophically. Investors who bought at the peak lost almost everything. The headlines of 2021 were the same as the headlines of 2022 and 2025. The technology was fraud. The bubble was always going to pop. The entire thing was delusion. Except none of that turned out to be correct. Here is the Wharton School observation that captures the principle precisely. Pets.com failed. By 2025, 55% of pet food sales are online. The thesis was correct. The timing and execution were not. The company died. The idea survived and quietly became enormous. Look at what survived. Amazon dropped 94% during the crash. Today, it is a $2 trillion company. From its post-crash low, it returned over 100,000%. Priceline, now called Booking, dropped 94%, worth $130 billion today. Survived because they had $125 million in cash, which gave them roughly 22 quarters of operations to outlast the contraction. eBay dropped 62%. Network effect, real transaction volume, real users, worth $25 billion today. Google was private during the crash, built a real advertising model on top of a genuine utility. Today, $2 trillion. Netflix survived the crash and pivoted from DVDs to streaming. The technology shift was already underway. They had the discipline to recognize where the actual market was going. Today, $300 billion. The survivors share a structural profile that maps directly onto what separates surviving crypto projects from dead ones. They were not the most prominent or most funded companies of the bubble era. They were the ones with real usage, sustainable economics, and enough runway to outlast the contraction of the underlying technology. It was a consequence of timings, execution, and premature speculation. The crypto equivalent of these survivors already exists. Projects with real transaction volume, sustained developer activity, institutional adoption, regulatory engagement, they have demonstrated the same structural resilience pattern across multiple down cycles. The technology is not the question. The question, as always, is which participants are operating with the structural tools to identify and position around the survivors. Now, the most consequential set of findings in this entire report. The most common assumption a newcomer carries into crypto is that the outcomes are random. Some people get lucky, most do not. The market is a casino. The data says something completely different. Crypto outcomes are not random. They are skill distributed. A 2025 paper by Conlon and others published in Financial Management examined professional cryptocurrency funds and found a 21% average annualized alpha. That is not total return. That is alpha. Excess return above what could be explained by passive market exposure. 21% per year, sustained. The alpha persisted up to 36 months. Funds with high historical alpha retained that feature in subsequent periods. The skill is not one cycle artifact, it compounds. 27% of the funds in the study showed statistically significant positive alpha when bootstrapped analysis was applied. Bootstrap methodology is specifically designed to distinguish skill from luck. 27% passed that test. Liu and Tsivinsky, in the review of financial studies in 2021, established the underlying mechanism. Crypto returns are driven by systemic identifiable factors: time series momentum, investor attention proxies. A follow-up paper in the Journal of Finance built the three-factor model analogs to the FAMA French factors in equities. 10 cryptocurrency characteristics formed into long-short strategies generated. In the paper's exact words, sizable and statistically significant excess returns. Bianchi and Babiak in 2022, examining over 200 actively managed crypto funds, used bootstrap methodology specifically to distinguish luck from skill. Their conclusion was unambiguous. Extreme outperformance is unlikely to be explained by luck. Cryptocurrency-specific factors explain only 40% of top-performing funds' returns. The remaining 60% was attributed to genuine manager skill. What this means is straightforward. The arena is learnable. Now, look at the other side of the same data. The Bank of International Settlements analyzed crypto exchange data across 95 countries and found that 73% to 81% of retail Bitcoin investors have likely lost money. NFT Evening 2024 survey of 1,005 retail traders found 84% lose money in the first year. Chag and others looking at Brazilian futures market in 2020 found that 97% of day traders lose money after 300 trading days. Only 0.5% earn more than a banker teller's salary. These two set of numbers tell you the same story. The top operators consistently outperform. The bottom 80% of retail participants consistently lose. The middle does not really exist. The BIS finding is even sharper. As price rose during 2017 and 2021 cycles, larger and more sophisticated investors sold while smaller retail investors bought. The whales, in the BIS phrase, were making a return at the smaller user's expense. The whales did not steal, they were not running scams, they simply operated with structure, and the people on the other side of their trades did not. This is the part of the conversation most influencers in this space will not have with you, because it does not flatter the audience. The arena is skill arbitrage. If you walk in without skill, the arena does not punish you. It collects from you, quietly, continuously, until you exit. Usually with the conclusion that the whole thing was rigged. It was not rigged. It was structured against unstructured participants. Those are different things. The NFT Evening survey went on level deeper and asked what specifically caused the losses. The three primary causes, ranked in order: poor research at 55%, undisciplined day trading at 54%, FOMO-driven entries at 44%. Notice what is missing from that list. Bad luck, market manipulation, unfair conditions. None of those rank as the primary cause of loss for retail participants who self-report. The cause are structural absence of process. Every one of them is directly addressed by operating with a clear framework, a defined role, and explicit governance rules. And there is a useful analogy to hold on to. The venture capital industry behaves the same way. The top quartile VC funds outperform public markets by 10 to 15% annually, even though more than 40% of their portfolio companies return less than the cost of investment. The top 10% of investments generated 60 to 80% of all global VC returns. Same power law dynamics, same implication. In 99% failure rate industry, random selection guarantees loss. Structural tools, role alignment, process discipline, governed decision making place the operator in a fundamentally different game. If skill is real, the natural question is what it actually identifies. What does a structurally durable crypto project look like? And how do you tell it apart from a structurally weak ones? AlphaQuest 2024 analysis of more than 12,000 CoinMarket projects identified the markers. They are not subtle. They are visible to anyone willing to look. That projects share the same structural fingerprint. Near zero trading volume. Abundant GitHub repositories with zero commits in 6 months or more. 99% or greater decline from all-time high. No working product, inactive or deleted social media accounts, anonymous teams that have disappeared, a white paper but no code, no exchange listings after the original ICO. Surviving projects show the inverse. Continuous developer commits, real transaction volume, not just trading volume, institutional integration or adoption, community governance with real participation, regulatory engagement and legal structure, sustainable token economics, multi-cycle developer retention, clear use case with measurable adoption. Two of these markers deserve specific attention. First, developer continuity. Electric's Capital 2024 developer report analyzed 902 million code commits across 1.7 million repositories. Established developers with 2 or more years of tenure reached all-time highs in 2024, growing 27% year over year. They committed 70% of all code in the industry. Developer continuity is the single most reliable leading indicator of infrastructure layer survival. If a project's most experienced contributors are still committing code 2 years after launch, it is significantly more likely to be alive in another 5. Second, real-world usage. The A16Z State of Crypto 2025 report identified this as the other critical survival metric. Stablecoins processed $46 trillion in transaction volume in 2025. Roughly 3 times Visa's annual volume. 40 to 70 million users were actively transacting on-chain. Projects anchored to real economic activity, payments, lending, trading infrastructure demonstrate materially higher survival rates across cycles than projects that exist only as price. The signal is real. It is publicly available. It does not require insider access. What it requires is the willingness to ignore the 99% of noise that surrounds it. And that willingness, in turn, requires that you have a role from which the noise is irrelevant in the first place. Which brings me to the final framework piece. The data establishes a clear structural reality. The crypto arena has an extreme failure rate at the project level and extreme loss rate at the retail operator level. The question is not whether failure is common. It is whether your operating role is structured to navigate that reality or to be consumed by it. There are 4 operating roles inside the arena. 2 axes. High volatility versus low volatility on one side, capital-driven versus skill-driven on the other. 4 quadrants emerge from those axes. 4 roles, 4 games. The first role, execution capital, the active operator. Day trading, swing trading, market making, arbitrage, quantitative strategies. The skill is pattern recognition and emotional governance. The operator navigates high failure rates through process, not prediction. The second role, allocation capital. The patient operator. Long-term allocation into major assets, structured portfolios, conservative yield. The operator ignores 97% of the market that compounds slowly into the surviving 1%. The skill is thesis discipline and drawdown tolerance. The third role, flow capital, the distributor. Personal brands, research, education, advisory, community building. The operator converts credibility into capital by identifying signal in noise. The skill is research quality and audience trust. The fourth role is enterprise capital, the builder. Exchanges, wallets, protocols, data tools, compliance layers. The operator constructs the infrastructure that survivors run on. The skill is system architecture and long-term horizon. These four roles describe almost everything that happens in this industry. Every dollar that flows through crypto flows through one of them. Here is why role alignment matters most in a high failure rate environment. A participant who operates in the wrong quadrant for their psychological and cognitive profile will not merely underperform. They will structurally fail, even when their analysis is correct. A patience-based nervous system in a high-frequency execution role will freeze at decision points. A fast-processing dopamine-driven operator in a long-duration allocation role will manufacture urgency and exit winning positions early. The failure is not strategic. It is architectural. Those roles are not strategies. They are operating environments. They have different rules. They have different rhythms, different stress profiles, different feedback loops. A trader and an investor are not running different versions of the same game. They are playing different games entirely. Their nervous system should not be the same. Their daily schedules should not be the same. Their information diets should not be the same. If you mix them, the system collapses. The roles are incompatible without explicit governance. Each role has a fundamentally different relationship to failure, to the 99% failure rate. The same data point that destroys one role is irrelevant to another. For the trader, execution capital, the 97% meme coin failure rate is irrelevant in the way most people imagine it. The skilled active operator is not selecting projects for the long-term value. They are extracting short-term price inefficiencies. The failure rate of underlying projects is, for them, the source of the inefficiency. The real risk is not bad analysis. It is operating without process discipline under high cognitive load. They lose to themselves, not to the market. For the investor, allocation capital, the 53% headline failure rate is already priced into a disciplined allocation strategy. The entire operating logic is built around the power law reality. Most projects fail. A small number produce outsized returns. Portfolio construction, position sizing, and conviction management are the core skills. Their failure rate is thesis drift, exiting winners early, holding losers too long, being talked out of a correct position by short-term noise. For distributor flow capital, the 99% failure rate is the source of value. In an industry where almost everything dies, the ability to identify structural signal from noise is genuinely scarce, and therefore genuinely valuable. The distributor converts the capacity into capital flow, audience trust, and economic position. The failure mode is the inverse of the role itself. Optimizing for attention over substance, saying what is engaging instead of what is true. The moment trust erodes, the role collapses because trust is the entire asset. For the builder, enterprise capital, the failure rate is irrelevant in the direct sense. The builder is not buying tokens. The builder is constructing the infrastructure that surviving projects depend on. When 20 million tokens are launched and 99% die, the surviving 1% still need exchanges, custody, analytics, oracles, compliance layers, developer tooling. Building durable infrastructure means building for the survivor's needs. That position is structurally insulated from project-level mortality because the failures themselves create demand for the systems builders provide. Notice what it means. The 99% failure rate is not a uniform risk that washes over everyone equally. It is a role-specific risk that manifests differently depending on the operating position you have chosen. A trader who is perfectly aligned with the execution role can profit from the same volatility event that destroys an investor without thesis discipline. The framework does not protect you from the failure rate. It creates the structural conditions to operate inside it. Most people lose money in crypto because they are operating the wrong role for their wiring. Volatility does not destroy capital first. It destabilizes identity first. People believe they are investors, react like traders, and panic like gamblers. 3 roles, 1 body, no governance. This is the central insight. I want to take a moment now before I get to the conclusion to be honest about something specific, because the rest of what I am about to tell you depends on this honesty. I have been in this arena for a long time. I have spoken about projects publicly. I have been involved with projects directly. Some have done well, many have not. This is the structural reality I have just spent most of this report explaining. The 97% figure does not exempt anyone, including operators with experience, including me, occasionally. Someone who lost money on a project I once mentioned reaches out, sometimes with strong language. I understand the pain behind it. Money is real, time is real. The expectation that someone with experience must somehow be able to protect you from the failure rate is real. I do not dispute the outcome, but I want you to hold what we have just covered against that frame, because the framework is the answer to it. I do not control projects in this industry. Nobody does. The arena selects against most of them by design. What any honest operator can do is study the architecture of which projects survive and the architecture of which participants survive operating inside an industry where most projects do not. Those are different questions. They have different answers, and both of them sit downstream of one upstream truth. In a 99% failure rate environment, individual project selection is a far weaker edge than role alignment and architectural discipline. I have lost money on positions I believed in. I have watched ideas I thought were structurally sound get killed by external events I could not have predicted. I have also watched operators with no obvious edge generate consistent returns over years by aligning correctly with their wiring and operating with discipline. The arena does not reward intent. It does not reward conviction. It does not reward sophistication. It rewards architecture. This is why this work is built around frameworks rather than picks. Picks are the most dangerous thing a person with my history could hand you. Because in 99% failure rate environment, even a 50% hit rate destroys most viewers who do not know what to do with the other 50%. Frameworks are different. A framework gives you structural lens to evaluate the next 100 projects you will encounter, regardless of who introduced them to you, including me. That is the most useful thing I can offer. Not certainty about projects, architecture for the operator. If you have lost money in this industry, I am sorry that happened. I have been there. The lesson is not that the industry is broken or that the people who introduced you to the projects are the cause of the loss. The lesson is the one this report has spent the last 40 minutes building toward. The 99% is real. Role confusion is the multiplier on it. Structure is the only protection. And nobody else can install structure for you. Now, the conclusion. The failure rate in crypto is not a scandal. It is not evidence of fraud, manipulation, or systemic corruption. It is the expected signature of emerging technology sector in its earliest phase of maturation, operating under conditions of permissionless innovation, near zero barrier to entry, and global speculative capital access. The dot-com era saw roughly half of all tracked internet companies fail. The Nasdaq fell 78%. $5 trillion evaporated. Yet, the survivors built a $15 trillion digital economy. Amazon crashed 94% and returned over 100,000% from its post-crash low. The technology did not fail. The structurally weak participants did. The same dynamic is operating in crypto. 4 findings to hold on to. Most projects will fail. This is the structural reality of any permissionless innovation ecosystem at early maturity. The failure rate does not determine your outcome. Your role alignment, process discipline, and structural framework do. Skill is real and measurable. Academic evidence confirms 21% average annual alpha and 36 months performance persistence for professional crypto operators. And the arena rewards structure, not intelligence, not effort, not luck. Structure, governance, alignment, process, which compresses into one principle. Crypto does not punish stupidity. It punishes the absence of structure. In an industry with a 99% failure rate, the only sustainable edge is architecture. That is the entire report in 2 lines, which is the only thing I'm asking you to do at the end of this video. Your first decision in this arena is not what to buy. It is what role to operate in. Take the Crypto Quadrant assessment. The link is below this video. It is short. You answer a series of questions about how you make decisions, how you respond to volatility, what you find energizing, and what you find draining. The output is a personalized report identifying your primary quadrant and your secondary quadrant out of the 4 roles I described. The primary is where your wiring naturally fits. The secondary is where you tend to drift under pressure, often in ways that work against you. The report tells you both. It also tells you the typical failure modes for someone with your specific profile and the structural conditions under which people with that profile thrive. It is free. There is no funnel waiting at the end of it. You take it, you read your report, you understand where you fit. After that, the rest of the work I publish under the Architect Substack newsletter will start to make sense in a way it cannot make sense if you do not know your role. I'm not asking you to buy anything. I'm asking you to orient yourself before you put capital at risk in an environment that is engineered to collect from people who walk in unoriented. The arena is large. The failure rate is real. The technology is genuine. The historical pattern is clear. The skill premium is measurable. None of that is in dispute. What is in dispute every cycle is which participants enter the arena oriented and which enter unoriented. Every other failure flows from that one upstream choice. Find the role first. Build the architecture second. Take the position third. In that order, not the other one. I'll see you in the next one. Take care.